When you look at a typical Fortune 500 company uh, preparing for a major leadership change, it almost always looks exactly the same.
Oh, yeah. Completely sterilized.
Right. Heavily engineered corporate theater. I mean, you've got the global search firm retained months in advance.
Yeah.
You've got these carefully manicured press releases detailing this multi-year transition timeline. It's all designed to project this aura of, absolute mathematical predictability to Wall Street.
Yeah, it's basically risk mitigation in its absolute purest form. I mean, the modern corporate board is just terrified of uncertainty. So they build these elaborate, highly visible runways to comfort the institutional investors.
Exactly.
They want everyone to know that the machine will continue to operate exactly as it always has, just, with a different person sitting in the corner office.
But then you look at Berkshire Hathaway, and you realize that they just do not play by those rules at all.
Mm.
We've been poring over the transcripts and the on-the-ground analyst notes from the May 2025 Berkshire Hathaway annual shareholder meeting.
The 60th meeting, by the way.
The 60th, yeah. Along with proxy statements, Q1 and Q4 2025 earnings releases, a ton of Reddit summaries from the floor, and Greg Abel's very first shareholder letter from early 2026.
A massive stack of material.
It really is. And what we found is that the transition of power at a company valued at over $1 trillion was handled with basically the casualness of, someone mentioning what they're having for dinner. So welcome back to another edition of The Deep Dive. Today, we are taking you right into the center of arguably the most monumental and certainly the most unique transition in modern financial history.
It really is a watershed moment for anyone paying attention. We're dissecting a conglomerate that has been built, shaped, and just entirely defined by the singular brain of one man for over half a century. And our mission today is to really figure out the mechanics of how this company is preparing to operate without him as the ultimate safety net.
Okay, let's unpack this. Because to really grasp how wild this was, we have to set the scene for you. Imagine you're in Omaha, Nebraska. It's May 3rd, 2025. You are sitting in the CHI Health Center arena along with roughly 40,000 other people.
Just completely packed.
Wall to wall. And sitting up on this relatively sparse stage is Warren Buffett, who is 94 years old, alongside his two vice chairmen, Greg Abel and Ajit Jain.
And, it's worth pausing just to acknowledge the physical and mental stamina that this specific event demands. I mean, these are not scripted earnings calls where an executive just reads a prepared statement and takes, 3 vetted questions from friendly analysts.
Right.
This is an endurance event. They sit up there for hours fielding totally unscripted, often highly complex questions from shareholders, financial journalists, critics. I mean, it's a grueling intellectual marathon.
And they've been doing this all day. They go through the entire morning session, take a break so everyone can go, buy See's candies and Brooks running shoes down on the exhibition floor, and then they come back and do it all over again in the afternoon.
Yeah. And it's right at the end of this exhausting, multi-hour session that Buffett, out of absolutely nowhere, casually drops the biggest news in the financial world. He just states that he is going to recommend to the board of directors the very next morning that Greg Abel officially become the chief executive officer at year-end.
What's fascinating here is the absolute nonchalance of the delivery juxtaposed against the sheer magnitude of the announcement.
Yeah.
He literally just said, the time has arrived where Greg should become the chief executive officer of the company at year-end.
Just like that.
No dramatic pause. No build-up. And the most incredible detail from the transcripts is that he admitted only his 2 children who sit on the board, Howie and Susie, actually knew he was going to say this.
Wait, I have to stop you there because that detail is just mind-blowing to me. If I am a board member of a trillion-dollar corporate empire and I'm sitting in the front row of this arena, you're telling me I am finding out about the CEO transition plan at the exact same millisecond as 40,000 retail investors.
Yes.
And, a guy wearing a foam cheesehead hat 3 rows behind me. That is exactly what happened. And it speaks to something totally unique about Berkshire's governance. I mean, most boards dictate terms to the CEO. At Berkshire, the board essentially functions as a trust exercise in Warren Buffett's judgment.
Wow.
Ron Olson, who has been on the board for years, actually commented on this later. He said that while the board was genuinely surprised by the timing of the announcement that afternoon, they were not surprised by the choice of the successor. The board had implicitly agreed years ago that Abel was the guy.
They just left the exact moment of the handoff entirely up to Buffett.
Exactly. It's an unbelievable level of autonomy.
And the reaction from the crowd, according to the on-the-ground accounts, was immediate. Just an arena of 40,000 people giving a roaring, extended standing ovation.
Which Buffett, of course, couldn't resist joking about.
Right. He said the wild applause for him stepping down could probably be interpreted in a couple of ways, but he was going to choose to take it as a compliment. But, as funny as that is, it immediately forces us to confront a really difficult structural reality. People always use that tired cliche of the relay race, right? Where the anchor runner is finally passing the baton. But I kind of hate that metaphor for Berkshire.
Why does that metaphor fall short for you?
Well, because a relay race implies that everyone is running on the exact same track, doing the exact same thing, just in sequence. But Berkshire isn't a track team. It's a massive, sprawling ecosystem with hundreds of totally different species.
Right. Railroads, energy grids.
Insurance companies, fast food chains.
Yeah.
If Buffett has been the central nervous system of that entire organism for 60 years, does a company of this sheer size really operate the same way without its iconic founder at the absolute helm?
That is the existential fear hovering over the stock, for sure. But if we dig into the operational history provided in these sources, we see that the brain wasn't actually swapped out on May 3rd, 2025. This wasn't a sudden amputation.
Okay, so more of a gradual shift.
A very slow, deliberate rewiring that started years ago. Greg Abel hasn't just been, waiting in the wings. He has been actively running all of Berkshire's non-insurance operations since January 2018.
Wait, so for 7 years leading up to this announcement, he's already been the guy making the calls for the railroads, the energy companies, the manufacturing sector.
Precisely. If you look at BNSF Railway or the massive utility grids or the retail operations, anything outside of Geico and the reinsurance float Abel has been the de facto chief executive of those divisions for a long time.
That makes sense.
And even with this official transition at the end of 2025, Buffett made it explicitly clear that he is not retiring to a golf course. He used this great phrase saying he would still hang around and could conceivably be useful in a few cases.
Conceivably be useful. That has to be the understatement of the century.
Truly. But the underlying mechanism of why he is staying around is really crucial. Buffett noted that the board of directors might be slightly hesitant to give Greg Abel sweeping, unchecked authority to execute a $50 billion acquisition on day one. But if the board knows that Warren Buffett is still sitting in his office, acting as a consigliere, a sounding board, they will be much more comfortable authorizing those massive capital deployments.
Yeah.
It provides a psychological safety net during those crucial first few years of the Abel era.
Right.
Plus, Buffett emphasized he has zero intention of selling a single share of his personal stock, stating he actually believes the company's economic prospects will be better under Abel's management than they were under his own recent tenure.
All right. So if Abel has effectively been running the physical machinery of the company for years, we really need to understand his DNA as a leader. So who is the person stepping into the most heavily scrutinized role in global finance?
So Greg Abel is 63 years old, born in Canada, and his background is fundamentally different from Buffett's. I mean, Buffett is, at his core, an allocator of capital and a picker of public stocks.
Oh.
Abel is an engineer of corporate efficiency. He is an operational mastermind. His story with Berkshire really begins in 2000 when Berkshire acquired Mid-American Energy. Abel eventually became the CEO of what was rebranded as Berkshire Hathaway Energy, or BHE, running it from 2008 to 2018.
And the defining characteristic that comes up again and again in these sources is his capacity for sheer grinding work. I mean, Buffett has publicly called him a tireless worker and an honest communicator.
And that honest communication was incredibly apparent in March 2026 when Abel released his very first annual letter to shareholders.
Oh, the tone of that letter was heavily analyzed.
Right. And what stood out was this very deliberate, profound humility. He wrote, "I am honored by our board's decision to appoint me CEO of Berkshire and humbled to succeed Warren." And he didn't try to sugarcoat it, adding, "Warren is obviously a very hard act to follow."
Which I think was just the smartest possible PR move he could have made. If you come in trying to emulate Buffett's folksy charm or his specific brand of wit, the shareholders will reject you like a bad organ transplant. You cannot out-Buffett Buffett. You just have to be yourself.
Exactly.
But looking at the analyst summaries and the investor reactions online to that letter, there is a very clear anxiety. They respect Abel's humility. They know he can run a power plant, but they're desperately looking for clues about his ability to manage the stock portfolio.
This is the fundamental fault line of the transition. Abel is a proven operator of physical, hard assets. He knows how to build wind farms and lay track. But is he a stock picker? Can he look at a publicly traded tech company or a bank and accurately assess its intrinsic value the way Buffett does?
And that anxiety is massively compounded by a detail buried in the late 2025 news cycle. Todd Combs left the company.
Yes, this is a critical piece of the puzzle. For years, Berkshire had this two lieutenants model for managing the public equity portfolio. Todd Combs and Ted Weschler were handpicked by Buffett, managing tens of billions of dollars.
And the assumption was always that they would collectively take over the stock-picking duties when Buffett stepped back.
Right. But in late 2025, Todd Combs departed to take a massive executive role at J.P. Morgan Chase.
So that entire succession thesis for the stock portfolio just evaporates. The two lieutenants model is effectively over.
Exactly. Combs leaving creates an enormous leadership vacuum. It forces the strategic burden of managing the massive public equities book much more heavily onto Greg Abel's shoulders, alongside Weschler. The market is agonizing over whether Abel will try to find a new lieutenant to replace Combs, or if this signals a broader shift in how Berkshire will operate entirely.
Let me push back on that for a second, though. Does it actually matter if Abel isn't a legendary stock picker? I mean, if his background is in buying and optimizing entire, wholly owned companies like energy grids and industrial manufacturers, maybe the Berkshire of the 2030s just stops trying to buy, 5% of publicly traded software companies. Maybe they just buy infrastructure outright.
That is precisely the shift many analysts are predicting. We might be witnessing the transition from passive compounding through the public stock market to active compounding through privately held industrial operations.
Wow, that's a huge pivot.
It is. Abel understands how to squeeze margin and efficiency out of a utility provider better than almost anyone on Earth. If that is his superpower, it stands to reason he will direct Berkshire's capital toward acquiring the types of businesses where he can leverage that operational expertise rather than just passively holding shares of tech giants.
And he certainly has the capital to do whatever he wants. Which brings us to the most staggering data point in this entire stack of sources, the balance sheet. If Greg Abel is the new general of this corporate army, we really need to look at the weapons he has at his disposal.
Oh, it's a heavily armored army.
Yeah, because throughout 2025, this number just kept climbing, and by December, it reached a level that is frankly difficult to comprehend.
By the end of 2025, Berkshire Hathaway's annual report showed their cash and cash equivalents, sitting at a record $373.1 billion.
Here's where it gets really interesting. $373.1 billion. Just to contextualize how absurd that number is, for you listening, that single pile of cash is larger than the actual cash reserves of Apple, Microsoft, Google, and Amazon combined.
It's staggering.
It's enough money to buy roughly 480 of the 500 companies in the S&P 500 outright, entirely in cash, without taking on a dime of debt.
It is an unprecedented hoarding of liquidity. To look at it proportionally, that $373 billion represents over 27% of Berkshire's total assets. Historically, over the last 2.5 decades, Berkshire has kept its cash position around 13% of total assets, so they've effectively doubled their historical cash weighting.
So what is the mechanism here? Why amass this much cash? I mean, I hear the phrase dry powder thrown around all the time, but at a certain point, doesn't patience just become paralysis? If you're sitting on $370 billion while the broader market is hitting all-time highs, aren't you technically failing your shareholders by not putting that capital to work?
That is the exact argument being leveled by activist investors and financial media right now. But we have to look at how Abel and Buffett define value. In his 2026 letter, Abel pushed back hard against the idea that the cash is a sign of paralysis. He explicitly defined the balance sheet as a strategic asset.
Right.
He wrote that this cash allows us to act decisively, invest when others are tentative or fearful, and stand firm when financial storms roll through.
But they haven't been acting decisively. That's the thing. Even when it comes to their own stock, they essentially halted their share repurchase program. The sources note they didn't buy back any shares in the spring of 2024, and that freeze basically extended through 2025.
And to understand why, we have to explain the mechanics of how Berkshire views buybacks and a new legislative hurdle that fundamentally changed the math. Historically, Buffett only buys back Berkshire stock when two conditions are met. They have ample cash, and he believes the stock is trading significantly below its intrinsic value.
Right, and just so we're all on the same page, intrinsic value is essentially what the business is actually worth based on its future cash flows, as opposed to what the chaotic stock market happens to be pricing it at on any given Tuesday.
Exactly. For a long time, the shorthand metric Wall Street watched was the price-to-book ratio. If Berkshire's stock price hovered around 1.2 times its book value, the literal value of its physical assets minus liabilities, Buffett would aggressively buy back shares, knowing it was a bargain.
Okay.
But recently, the stock has been trading closer to a 1.5 price-to-book ratio. It's fully valued, if not slightly expensive, by historical standards. But beyond the price, Buffett explicitly called out a new frictional cost during the 2025 meeting, the 1% excise tax on share repurchases.
Okay, let's dive into this, because a 1% tax sounds like a rounding error to a normal person. If I pay a 1% fee on a mutual fund, I might grumble, but it doesn't fundamentally alter my life. Why does this matter so much to a company with $370 billion?
Because of the sheer scale of the capital involved, Buffett used Apple as the primary example to explain this to the shareholders. He pointed out that if Apple decides to do a $100 billion share repurchase program, which they have done, they now have to write a check to the federal government for an additional $1 billion just to execute that transaction.
Oh, wow.
That is $1 billion of shareholder value vaporized simply as a frictional cost of the trade.
That is wild to think about. It's $1 billion toll booth just to buy your own company's stock.
And Buffett stated that this tax makes buybacks slightly less attractive. It changes the actuarial math. When you are looking for absolute guaranteed margins of safety, suddenly having to factor in an immediate 1% loss on the transaction means the stock has to be even cheaper than before to justify the purchase.
Yeah, that makes perfect sense.
He emphasized they will only pull the trigger on buybacks if the shares are almost certainly underpriced and valued very conservatively. If we connect this to the bigger picture, this patience is really the ultimate lesson here. It's about not forcing a swing when there's no fat pitch, even when you have billions burning a hole in your pocket.
So when we look at this cash pile, it really flips how we normally think about investing. When you have an app on your phone and you have cash sitting in your brokerage account, there's this massive psychological pressure to do something, to buy the dip, to chase the momentum.
Absolutely.
But the lesson from Omaha seems to be that having the discipline to sit on your hands, even when Wall Street analysts are screaming that you're losing your touch, is a competitive advantage. You can't force the market to give you a bargain.
You cannot conjure a fat pitch. You can only stand at the plate and wait.
But that brings us to the assets they do own. Because even with $373 billion in cash, the public equity portfolio is still gargantuan. And the most heavily scrutinized piece of that portfolio in 2025 was, without a doubt, Apple.
It was the undeniable elephant in the room at the CHI Health Center. The optics were incredible. Tim Cook, the CEO of Apple, was physically present in the arena. They had reserved seating for him.
Yeah.
And from the stage, Buffett went out of his way to shower Cook with praise. He explicitly said, "Tim Cook has made Berkshire a lot more money than I've ever made Berkshire Hathaway."
Which is a beautiful, gracious thing to say.
Uh-huh.
But if you look at the balance sheet, it tells a very different story than the rhetoric on stage.
It absolutely does. Leading up to this meeting in the middle of 2024, Berkshire took an absolute hatchet to its Apple position. They slashed their stake by nearly 50%, selling off tens of billions of dollars worth of shares.
Right.
It was a massive capital extraction that heavily fueled that $370 billion cash pile.
So if I'm a shareholder, I'm trying to decipher this contradiction. You love the CEO, you praise the company, but you dump half your stock. Why? Is this just a portfolio concentration issue? Like that Apple just grows so much that it was becoming too large a percentage of Berkshire's net worth and they needed to rebalance? Or is this Greg Abel looking at a tech company, realizing he doesn't fully understand the 20-year horizon for consumer electronics the way he understands a freight train and deciding to cash out?
It's likely a combination of both, but the implications for the future are massive. If Abel views Apple as a legacy Buffett trade, a great run that has reached its peak valuation, we might see him continue to liquidate that position to fund acquisitions in his own wheelhouse of hard assets. It forces us to ask, where does a company with hundreds of billions of dollars go to find true, uninflated value right now?
And the answer clearly was not in the United States, which leads us to one of the most brilliant, sophisticated, and yet beautifully simple investments Berkshire has made in the last decade, the Japanese trading houses.
This is a masterclass in long-term capital allocation. Berkshire currently has roughly $20 billion deployed across 5 major Japanese conglomerates: Mitsubishi, Mitsui, Itochu, Marubeni, and Sumitomo.
And these aren't tech startups. These are ancient, sprawling, deeply entrenched businesses that deal in the physical building blocks of the global economy: metals, energy, textiles, food.
But the thing that absolutely fascinates me about this play isn't just the companies they bought, it's the exact financial mechanism they used to buy them. Because they didn't just log into a brokerage account and convert US dollars into Japanese yen, right?
No, and understanding why they didn't is crucial. When you invest in a foreign market, you are exposing yourself to two separate risks. First, the risk of the business itself, will the company succeed or fail? Second, you take on currency risk.
If you take US dollars, convert them to Japanese yen, and buy a Japanese stock, you are now at the mercy of the foreign exchange market. Even if that Japanese stock goes up 20% in value, if the Japanese yen simultaneously loses 20% of its value relative to the US dollar, your actual return when you bring that money home is zero.
You win on the stock, but you lose on the currency. It's a hidden trapdoor.
Exactly. So to eliminate that trapdoor, Berkshire engineered a brilliant natural hedge. Instead of converting their own US dollars, Berkshire Hathaway issued corporate bonds denominated in Japanese yen. They effectively went to Japanese capital markets and borrowed billions of yen. And because Japan's interest rates have been historically kept near zero by their central bank, Berkshire was borrowing this money for practically nothing.
Wait, so let me get this straight. They borrowed cheap Japanese money, and then they used that exact same borrowed Japanese money to buy the Japanese stocks.
Precisely. The asset, the stock, and the liability, the debt, are now in the exact same currency. If the Japanese yen plummets in value against the dollar, the US dollar value of their Japanese stocks goes down. But simultaneously, the US dollar cost of paying back that Japanese debt also goes down by the exact same amount.
That is just elegant.
The currency fluctuation completely cancels itself out on the balance sheet.
It allows them to completely ignore the macroeconomic currency noise and just collect the massive dividends and the underlying business growth of those trading houses. And what I love even more than the financial engineering is the anecdote from the 2025 meeting about how Buffett actually sourced these investments, because we live in an era where hedge funds are using AI to scrape satellite imagery of retail parking lots to predict earnings. But how did Buffett find these 5 companies?
He was literally sitting at his desk in Omaha, flipping through a physical, printed Japanese company handbook.
A physical book.
Yes. Someone noted they saw this massive, thousands of pages long manual on his desk, covered in dog-eared pages and margin notes. He was reading the raw financial fundamentals, the balance sheets, the cash flows, the dividend yields of thousands of Japanese companies, one by one, in print.
That is incredible.
It is the ultimate rejection of modern algorithmic Wall Street. It proves that identifying deeply mispriced assets doesn't require a supercomputer. It requires patience and understanding of accounting and the willingness to do the tedious work that no one else wants to do.
And they aren't looking for a quick flip here. The sources highlight that both Abel and Buffett have stated they intend to hold these Japanese assets for 50 to 100 years. Let that sink in for a second. Buffett is 94 years old, and he is initiating capital deployments with a century-long horizon.
It is the ultimate expression of the compounding philosophy. However, Buffett did express one profound regret about this investment during the meeting, and it highlights the curse of Berkshire's success. He said that while they have $20 billion in these companies, he would rather have $100 billion than $20 billion.
The problem of scale.
Exactly. When your asset base approaches $1 trillion, size becomes the enemy of performance. If you manage $1 million portfolio, and you find a brilliant little company and invest $100,000 and that stock doubles, your overall net worth jumps by 10%. It moves the needle.
Yeah.
But if Berkshire Hathaway finds a brilliant $500 million company and buys the whole thing and it doubles in value, it's a rounding error. It doesn't even register on their consolidated earnings. The universe of investments large enough to actually impact Berkshire's bottom line has shrunk to maybe a couple of dozen companies globally.
Which is why they have to hunt in places like Japan or sit on $373 billion waiting for a catastrophic market dislocation. But as much as Berkshire likes to operate in its own value investing vacuum, they are fundamentally tethered to the reality of the global economy. Their operating subsidiaries build things, ship things, and sell things. Which brings us to arguably the most heated macroeconomic reality discussed at the 2025 meeting: trade policy and tariffs.
And it is fascinating to look at this strictly through the lens of $1 trillion balance sheet. Regardless of the intense political debates happening in Washington regarding trade, Buffett and the CEOs of Berkshire subsidiaries simply have to deal with the economic math.
Right. And just to be totally clear to you, the listener, we are simply reporting Buffett and Berkshire's views on current U.S. trade policies here. We are remaining entirely neutral on the political merits of this. We just want to look at how it affects the business. So during the Q&A, Buffett was incredibly blunt about how he views the math of tariffs.
He was unequivocal. A shareholder asked him to compare a theoretical idea he had decades ago about import certificates to the actual implemented tariff environment of 2025. And he stated, there's no question that tariffs can be an act of war.
Act of war. Strong words.
He called the weaponization of global trade a big mistake. His argument was rooted in classical Ricardian economic theory, the concept of comparative advantage. His view is that the United States should ruthlessly focus on producing the goods and services it is naturally best at, and allow other nations to do the same, facilitating frictionless free trade between them.
Because if you introduce tariffs, you are essentially introducing friction. You are creating a tax that is ultimately paid by the consumer, and you run the risk of retaliatory tariffs that slow down global growth. He explicitly warned that enacting trade policies designed to make other nations envious or antagonistic is incredibly dangerous for long-term global stability.
Exactly.
But what really jumped out at me from the sources isn't just the high-level macroeconomic theory, it's how these tariffs are actively causing chaos for the managers actually running Berkshire's companies.
Yes, the abstract theory becomes a very real operational nightmare when you are trying to run a retail supply chain. The transcripts gave us a direct look at this through the lens of subsidiaries like Brooks Running Shoes and other consumer goods divisions.
Oh, the Brooks scramble.
Right. These executives were describing an absolute scramble to navigate shifting political deadlines. For example, there was a major looming July 9th deadline in 2025 where massive tariff rate hikes were scheduled to take effect.
And the response from the market was textbook panic buying. The sources noted that retailers were frantically trying to import and stockpile as much inventory as physically possible by mid-May to beat that July 9th deadline. One executive actually used the term FOMO, fear of missing out, to describe the behavior of wholesale buyers.
But that creates what supply chain experts call the bullwhip effect. You get this massive artificial surge in sales and shipping volume in May and June as everyone stuffs their warehouses full of pre-tariff goods. But it's a sugar high. Once those warehouses are packed or once the tariff deadline passes, new orders plummet to zero.
It makes forecasting completely impossible for these managers.
Exactly. It forces these subsidiaries into incredibly costly dual-path planning scenarios. The management team at Brooks, for instance, has to build one entire logistical model based on tariffs staying at 10% and a completely separate parallel supply chain model for how they will survive if tariffs spike to 40% or 50%.
That sounds miserable.
They have to constantly evaluate if they can source raw materials locally in the U.S. to avoid the tax, which, for many specialized textiles or electronics, is simply impossible in the short term. It requires massive, inefficient reallocations of capital just to deal with political uncertainty.
And tied directly into this macro anxiety was the discussion around the U.S. deficit and the strength of the dollar. A shareholder explicitly asked Buffett about the U.S. dollar rapidly losing purchasing power in 2025 relative to foreign currencies.
And Buffett's response was quite sobering. He pointed to the structural reality of fiat currency, stating that the natural historical course of any government is to eventually make its currency worth less over time to service its own debts. He actually called this a scary phenomenon.
He specifically called out the deficit numbers, right?
Yes. He noted that the U.S. fiscal deficit was running at roughly 7% of gross domestic product. He argued that this level of deficit spending is completely unsustainable over the long term without heavily depreciating the dollar. He suggested that a 3% deficit to GDP gap might be manageable, but expressed deep skepticism that Congress possesses the political will to enact the pain necessary to lower it to that level.
But, and this is a really important distinction for how Berkshire operates, he also made it clear that they do not run their businesses based on these macro fears. He explicitly said there has never been a single Berkshire board meeting where they decided to acquire a company or sell a company solely based on how currency fluctuations might impact their quarterly earnings.
It's the difference between macro awareness and macro dependence. They are aware the dollar might weaken, but they still only buy businesses that possess strong competitive moats and pricing power. If you own a railroad and the dollar loses value, the nominal price you charge to move freight simply goes up to match inflation. The underlying utility of the physical asset protects you from the currency degradation.
Which brings us to the actual engine room of the company. Because while the macro whines, the tariffs, the currency fluctuations, the deficit fears howl outside, the internal mechanisms of Berkshire have to keep generating cash. And the beating heart of that engine is, and always has been, the insurance operations. Before we even talk about the 2025 numbers, can we just pause and explain why insurance is so vital to this company? We hear the word float thrown around endlessly, but practically, how does that actually work?
It is the secret to Berkshire's entire empire. When you buy car insurance from Geico, you pay your premium today. But Geico might not have to pay out a claim on your policy for months or years or maybe never. That pool of money, the premiums collected but not yet paid out, is called float.
So it's essentially in a massive pile of cash that doesn't actually belong to Berkshire, but they get to hold on to it.
Better than that. As long as the insurance company operates at a slight underwriting profit, meaning they take in more in premiums than they pay out in claims and expenses, that float is effectively a loan that carries a negative interest rate. People are paying Berkshire to hold their money.
That's amazing.
Right. Buffett then takes that massive pool of free leverage and uses it to buy railroads, energy grids, and Apple stock. And by Q1 of 2025, the sources indicate that Berkshire's total insurance float had grown to an astronomical $173 billion.
That is $173 billion of free money they can invest. And the person overseeing this massive engine is Ajit Jain, the vice chairman of insurance. During the 2025 meeting, he had to address the most disruptive force hitting the insurance underwriting industry: artificial intelligence. How is AI going to change their ability to calculate risk and price policies?
Jane's perspective was characteristically measured, avoiding the tech utopian hype. He acknowledged that AI is absolutely going to be a real game changer for the insurance industry, particularly in automating claims processing and refining actuarial underwriting models. But he was adamant that Berkshire is not attempting to be a bleeding-edge first mover in deploying AI capital.
Which is classic Berkshire. Why spend billions doing the R&D when you can just wait for the tech to become a commoditized utility and buy the winner?
Exactly. Jane stated they are taking a strict wait-and-see approach. They want these specific, highly profitable use cases to clearly manifest before they integrate it broadly. And Buffett added a wonderful human element to this, saying from the stage that he wouldn't trade everything developed in AI over the next 10 years for Ajit Jain.
That's high praise.
It was a profound statement about the enduring value of seasoned human judgment when pricing catastrophic risk.
But human judgment still relies on accurate data. And we finally saw Berkshire catch up to the modern data era with Geico. For years, Geico was actually losing market share to competitors like Progressive because Geico was painfully slow to adopt telematics.
Right. Telematics is the use of apps or devices plugged into a car to actively track a customer's driving behavior: how hard they brake, how fast they accelerate, how often they drive late at night. Progressive used this granular data to perfectly match insurance pricing to actual driver risk, while Geico was still relying on broader, less accurate demographic model.
It was a huge blind spot.
But the 2025 sources confirm that Geico has finally successfully integrated telematics, which has completely turned around their underwriting profitability and directly contributed to that $173 billion float record.
So the insurance side of the house is humming. But the other side of the engine room, the massive physical infrastructure and utility side, the division that Greg Abel literally built, is facing a terrifying existential crisis. And this resulted in perhaps the most tense exchange of the entire 2025 meeting. I'm talking about the wildfire liabilities facing Berkshire Hathaway Energy.
This is a complex legal and operational nightmare. In 2020, devastating wildfires swept through the western United States, ravaging territories serviced by utility companies owned by Berkshire Hathaway Energy, specifically PacifiCorp.
And the problem isn't just that their power lines might have sparked a fire. The problem is the specific legal framework in these states. Can you explain the concept of inverse condemnation? Because that seems to be the trapdoor here.
Inverse condemnation is a legal doctrine used in several Western states that essentially holds utility companies strictly liable for property damage if their equipment is found to be the cause of a wildfire, even if the utility company was not negligent.
Wait, let me make sure I understand that. Even if the utility company perfectly maintained the power lines, followed every single safety regulation, and an unforeseeable lightning strike or a freak 90-mile-per-hour windstorm knocks a branch into the wire and starts a fire, the utility can still be forced to pay billions of dollars in damages.
Yes. Because the utility is providing a public service, the courts view them as a mechanism to socialize the cost of the tragedy. They are treated as the deepest pocket available to compensate the victims. This transforms a utility company from a slow, steady, predictable dividend generator into an entity carrying potentially infinite, uncapped catastrophic risk.
A shareholder brought this up directly during the meeting, pointing out the billions of dollars in pending litigation and potential future liabilities. And this was Greg Abel's moment. He had to stand up, address this existential threat, and hold the line.
And he was remarkably firm. He openly acknowledged that the 2020 wildfire liability is the single largest challenge facing Berkshire Hathaway Energy. But he drew a definitive line in the sand, stating unequivocally that private utility companies cannot be the insurer of last resort for an entire state's climate disasters.
So doesn't this create an impossible paradox for Abel? As the new CEO, he is expected to deploy billions of dollars of that cash pile into capital expenditures, modernizing the electric grid, building renewable energy infrastructure. But if you pour $10 billion into upgrading a state's grid, and the legal framework of that state dictates that a single dry summer and one sparked wire could bankrupt the subsidiary through litigation, why would you ever invest that capital?
You wouldn't. This raises an important question about the future of infrastructure. And that was exactly Buffett's add-on point. He stated that the United States desperately needs an intelligent, comprehensive energy policy to solve this liability framework, because if the risk-reward ratio remains fundamentally broken, private capital will simply abandon those states. Berkshire will just stop investing in grid modernization where inverse condemnation exists.
It is a harsh reality check. Everyone looks at Abel inheriting $373 billion in cash and thinks he has the easiest job in the world. But he is also inheriting massive, incredibly complex operational and legal landmines that cannot be solved simply by writing a check, which sets the stage perfectly for what the financial world is bracing for next. All of these massive narrative threads, the official succession, the unprecedented cash hoard, the mysterious Apple trim, the tariff disruptions, the wildfire liability, they are all converging on a single date, May 2, 2026.
The upcoming 2026 annual shareholder meeting will be a cultural shock to the system for Berkshire investors. For the first time in 6 decades, Warren Buffett will not be presiding over the arena as the chief executive officer.
So what exactly is this new Woodstock of capitalism going to look like? How is Abel structuring his debut?
The format is undergoing a massive, deliberate overhaul. Buffett will likely be present in his new role as chairman emeritus, but he will not be hosting the marathon Q&A. Greg Abel will step to the podium alone to deliver the primary business update. After that, the Q&A session will be entirely restructured to reflect the true, decentralized nature of the conglomerate.
They're splitting it up, right?
Yes. The session will be divided by operational expertise. First, Abel will share the stage with Ajit Jain to handle all questions specifically relating to the insurance float, Geico, and reinsurance risk. Once that concludes, Jain will leave the stage, and Abel will be joined by 2 other crucial executives who have historically operated behind the scenes. Katie Farmer, the CEO of the BNSF Railway, and Adam Johnson, who leads the sprawling consumer products and retail divisions.
This is such a fascinating psychological pivot. For half a century, the message to shareholders was essentially, don't worry, Warren and Charlie Munger are sitting on this stage, and they understand absolutely everything about every business we own. Now, Abel is explicitly saying, I am the CEO, but I am not the omniscient oracle. I rely on these operational experts. By bringing Farmer and Johnson into the spotlight, he is physically demonstrating the depth of the executive bench.
It is a necessary evolution. He has to prove to Wall Street that Berkshire's famously decentralized model, where subsidiary managers are trusted to run their fiefdoms with minimal interference from headquarters, is not just a byproduct of Buffett's management style, but a durable, institutionalized corporate culture that will outlast him.
But format changes and executive showcases will only buy him so much goodwill. The honeymoon period for a new CEO, even one internally groomed for years, is remarkably short. When you look at the analyst notes forecasting the 2026 meeting, what are the institutional stakeholders actually demanding from Abel?
Wall Street is preparing to press him on 2 glaring immediate questions. The first, predictably, is capital allocation. With cash approaching $400 billion and the stock trading around a 1.5 price-book ratio, the pressure on Abel to accelerate share buybacks will be immense. Investors want to know if Abel will be more aggressive than Buffett in defining intrinsic value. If Abel signals that he is willing to authorize massive repurchases even at slightly higher valuations, it would fundamentally reset how the market prices Berkshire stock.
But as we discussed, he has to balance that demand against the reality of the 1% excise tax and his own belief that the cash is dry powder for a market crash. What's the second demand?
The second major question revolves around the public equity portfolio, specifically the rotation out of tech. After the massive Apple trim in 2024, analysts are desperate to know if Abel views the remaining Apple stake as a permanent, untouchable holding the way Buffett viewed Coca-Cola, or if he views it simply as an oversized, mature position that needs to be actively managed and perhaps sized down even further.
If he commits to holding Apple, he signals continuity with the late Buffett era. But if he hints that the tech rotation is going to continue and implies that capital will be redirected toward the energy, utility, and industrial sectors that he personally understands best, that represents a profound strategic break from the last decade of Berkshire's growth.
It would signal the true beginning of the Abel era, a return to hard assets and operational compounding.
So what does this all mean? When you look at all of this, the leadership transition, the macro headwinds, the strategic pivot, it completely changes how we have to view this company. For years, investing in Berkshire Hathaway was essentially an exercise in outsourcing your financial anxiety to Warren Buffett. You bought the stock, you went to sleep, and you trusted the grandfather of value investing to protect your wealth. We are now watching an unprecedented real-time stress test of whether a corporate culture can truly survive the departure of its architect.
The culture was meticulously designed to outlast the individual. I mean, the operating businesses, from the railroads to the retail stores, generate massive independent cash flows. The insurance float provides a perpetual low-cost funding mechanism. The balance sheet, fortified by nearly $400 billion, is practically impregnable against macroeconomic shocks. But the ultimate connective tissue, the singular capital allocation decisions at the very top of the pyramid, that responsibility now rests squarely on Greg Abel.
And if there is one overriding realization that we should all take away from studying this transition and that massive cash pile, it's that patience is the ultimate unmatched superpower in investing. In a modern financial ecosystem that is entirely obsessed with daily trading volume, gamified brokerage apps, algorithmic momentum chasing, and immediate gratification, the most successful compounding machine in human history is perfectly willing to sit on hundreds of billions of dollars for years, enduring the mockery of financial media, simply waiting for the exact right moment to swing the bat.
They absolutely refuse to let the chaotic emotional swings of the stock market dictate their internal corporate actions. They adapt to the macroeconomic reality, but they operate entirely on their own century-long timeline.
But as we wrap up this deep dive, I want to leave you with a final thought. It's a question that wasn't explicitly answered in any of the proxy statements or analyst transcripts we reviewed, but one that is quietly terrifying institutional investors. For decades, Berkshire stock price has traded with an invisible, unquantifiable markup, the Buffett premium. Investors willingly paid a slightly higher multiple for the shares simply for the psychological comfort of having the Oracle of Omaha managing their money. Now that the Oracle has officially stepped back, what happens to that premium?
It is the ultimate unknown variable. If the broader market decides to strip away that psychological premium, Berkshire stock price could stagnate or even dip during Abel's early tenure, entirely independent of the company's actual operating earnings.
And if that happens, if the stock drops and the value stagnates, will this new, untested management team face immense, aggressive pressure from Wall Street activist investors to do the absolute unthinkable? If they are sitting on $400 billion in cash and the stock isn't moving, will Greg Abel be forced to authorize a dividend payment for the first time in the company's history? And if Berkshire Hathaway, the ultimate engine of retained earnings and compounding capital, finally bows to Wall Street and pays a dividend, does that irrevocably destroy the fundamental nature of what made the company special in the first place? It is a question that could genuinely redefine the landscape of American capitalism over the next decade.
The historical roadmap has officially run out. We are navigating the completely uncharted waters of a new era.
A perfect place to leave it. Keep digging into your own deep dives. Keep questioning the consensus. And we will see you next time as we continue to decode the forces shaping the markets. Take care, everyone.